the accounting out of the 2024 study guide. So it's set up different. The module 3 set up different from the older study guide where you had fiscal law, then finance, then accounting. Now it's just finance and then accounting. So that's how we're going to go over it. If at any time you have any questions, for those on the live session, feel free to ask your questions. And if you're watching the video later on, then you can always type the comments or reach out to me and I will try to answer your questions. All right, so overview of, so what I noticed with the accounting is they tied in some of module 2 and module 1 into the accounting portion. So I think it starts off differently, but these are information that you should already know, such that it starts off talking about the Authorization Act and the Appropriation Act. So you kind of have to recap what you know about the authorization process, the appropriation process. Which house is responsible for the authorization process? That's the House and Senate Armed Services Committee. The Appropriation Act is the House and Senate appropriators. And so just kind of recapping what you already know. It references again the presidential action in Article 1, Section 7, that the president has the 10 days to approve a bill. If Congress is in session, it will automatically become law if the president does not approve it in them 10 days. If Congress is adjourned, then it's a pocket veto. So all it's doing is recapping information you would have already learned in module 1, I think. And you'll see it again in module 2. So let me scroll down. So it goes again into the Budget and Accounting Act that created the position of the Government Accountability Office, that's GAO. That's the external auditing agency that works directly for Congress. So they audit the executive branch. You have, let's see, another one we talked about last session was the Prompt Payment Act, came out in 1982, where it required us to pay our bills when they're due or you pay interest. And you can't not pay in advance unless it's advantageous. So don't pay the bill too early unless it's advantageous to the government, such as if that contract has 210 net 30, says if I pay the bill early, within 10 days, I can take a 2% discount. That is advantageous to the government because you pay less. Another law that is quite popular in the CDFM is the 1990 Chief Financial Officers Act, where it requires a CFO in all your federal agencies, and it also requires financial reporting, such as on the commercial side. The accounting portion also goes into who OMB is as far as the Office of Management and Budget. They are the CFO for the executive branch. It talks about the GAO that works for Congress. It talks about the Department of the Treasury, another key player in this whole process because they are the nation's banker, the federal government's bankers, the Treasury Department. And then you have, in accounting, you have the Federal Accounting Standards Advisory Board. That's the forum that's made up by, it was created and established 1990 by the Comptroller General. So whenever you hear the word Comptroller General, that is the title of the individual in charge of GAO. So the FASAB was established in 1990 by the GAO head, the Secretary of the Treasury, and the Director of OMB. And their job is to come up with the standards, the accounting standards for federal government. Let's see. So the generally accepted accounting principles. So there's several of them. you just kind of be familiar with them. Like the first one, objectives of federal fine. Why do you have to do reporting is basically what it's saying. Entity and display. I think these were in the older books, so I'm not going to go through these because they're pretty straightforward in what they are. And they basically just explains why you need financial reporting. It also goes into the DoD FMR 7000.14R. That's the Department of Defense Financial Management Regulation that provides the policy and procedures within the responsibility of the USD. That's the one that has the different volumes, and it tells you which one deals with accounting. That's volume 4. So it had volumes 1 through 16. Volume 4 deals with the accounting policy. So there are different types of government funds. You have the general fund, special funds, intra-government funds, and public funds. And if you think about it, even if you didn't know the terms, it's like, yeah, you have some that are general, meaning it's not tagged for specific things, such as when an individual pays for an item and you have a cash collection voucher that we talked about last week, that fund goes into the general fund or general miscellaneous receipts funds of the Treasury. Does anyone have any question? So other types, while I'm talking, trust funds, revolving funds, like the working capital fund, that's a revolving fund, deposit funds, clearing. Whenever you have a list like that, that means you need to know what that makes up that list. If they say, what are some examples of government funds? Then you'll be able to go down. The main ones are general, special, public, and intra-government. And then you have other funds such as the trust fund, revolving fund, and so forth. You have to know the definitions, which you should already know, of appropriated funds versus NAF funds, non-appropriated. And what do you mean when you say reimbursable funds versus revolving? They're exactly what they are. Reimbursable means the customer provides the fund and another agency does the work for it. So they're reimbursed for the money they pay to do that job. So there are different categories of appropriations. Nothing new here. You have annual appropriations. Who can tell me what are the annual appropriations? Because you should already know those. Anybody would like to take a, I won't say
That would be
Go ahead, sir.
annual.
What are two types of annual appropriation?
We're not talking about operation and maintenance, right?
That's one.
And then military pay. Is military purse or military pay?
Mill purse, so military purse. Yeah, mill purse. So your annual appropriations, the ones that you're going to deal with CDFM is O&M and mill purse. Then you have multi-year appropriations. That's your RDT&E, the 2-year one. The procurement is the 3-year. Shipbuilding, conversion, Navy, and military construction are 5 years. Those are multi-year. And the procurement and the MILCON is also called investment type. So there's versus if they ask you type versus the type, the appropriation itself. It's a multi-year appropriation, but it's an investment type appropriation. So it's a play on words, basically. So each appropriation has a legal time. This is the same thing you learned in Module 1, which is what I just repeated. 1 year versus 2, 3, 5. And what does those years mean? If I say MILPER is a 1-year appropriation, that means you have 1 year to obligate those funds, new obligations. And after that, it enters the expired state for 5 additional years. Nothing new here. It also goes into commitments, administratively setting the funds aside, for a particular purpose. Obligation is legally binding the government. You enter into a contract. Obligation of funds. How do we obligate funds? Do we just go into the systems and just obligate? Nope. We have to have an obligating document, something that gives us the ability to do so, such as a contract, grants, MIPR, military interdepartmental agreement. So you have to have the supporting document or order that give you the ability to obligate those funds. Transfers. So don't forget the definition of what's the difference between a transfer and reprogramming action. Who can tell me what is the difference? What's the definition of a transfer?
Isn't transfer moving the money from essentially one location or one, what's the word I'm looking for? Almost,
Appropriation,
yes, one appropriation to another appropriation, and reprogramming is changing what the money's being used for
right?
inside of that appropriation.
Right. So you can kind of think of what do you do when we reprogram, we're still within the same appropriation. So you're reprogramming within the appropriation. Transfer is taken from one appropriation. And of course, you have to have the authority to do this. So whatever that threshold is, that authority to tell you, okay, then you can transfer. So it's transfer out or reprogram within. So make sure you know the difference between that. I think these forms are new. I don't remember seeing these in the older books. So DoD uses several forms to track and control the appropriations. They use a DD form 1414. That's the basis for reprogramming. So as I mentioned, you have to have the authority to do so. So this document lists the funding provided for each of the programs. So I'm going to highlight these. So I'll try to put these, since I think these are new, because no, I don't remember everything. So what I try to do, if it's something new, I'll put it in the notes that I'm creating for this section. Any question? All right. So even though we're in the accounting, it goes again into the defense working capital fund. What can y'all tell me about the working capital fund? What do you know about it? How does it
It's
work? Go
X
ahead.
year appropriation.
Say again.
Is it X year?
X year. Okay. That's correct. What else do you know about it?
Isn't it based on money that the Defense Department generates itself?
Correct. And so it works exactly the same as the commercial side, where that commercial organization, so your DoD working capital fund organization, takes their money to build the item, buy the item, put it on the shelf, such as your commissary. And then based on how much it costs them to put it on the shelf, they charge a price for your meats, your milk, your cheese. And then, but there's a major difference. So if it's the same thing as a commercial side, what is the difference between the working capital fund and the commercial? What's the major difference? Because that's what the commercial side does. They take their money, get the item, put the
Uh,
item on the shelf. What's the difference?
it's not for profit. So at any point, if they are over a certain threshold profit wise, they have to decrease the prices of the items that they're
Right?
selling.
And that is the major difference from the commercial side. Because if you just stop at, yeah, they take their money, buy the item, put it on the shelf, charge the customer, well, that sounds exactly like everybody else. The difference with the government side is the goal of the working capital fund is to break even over time. So they have to pay a close attention to the trend. If the trend is profit, 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 then you pretty much can know that it's about time for the price of that meat to drop. That's when you go buy all your ribs and your steak from the commissary. And if I'm not mistaken, they post their prices per fiscal year or per year. So they don't like change it kind of like the other grocery stores. You can go in 1 week, it's one price. So, but yeah, don't quote me on that one. It also goes in the accounting. It talks more about continuing resolution. So all you do, look at the topic and rehash what you already know, stopgap to ensure that the government doesn't shut down. You gotta use your same rate of operation as the previous year. So you go through all of those, no new starts, no new contracts, or else you will have a lapse in appropriation. So they use the term and they give the definition of what it means to have a lapse. It's a funding gap. So if we don't get an appropriation this week, then come Monday, it'll be a funding gap. Well, actually, Friday, late Friday, early Saturday. All right, so let's see what else they have. So some other repeat is the life cycle of the appropriation. As I mentioned, they are available for those time frame. Every appropriation state expired for an additional 5 years, and at the end of that expired state, it is closed or canceled, and those funds are returned to the Treasury. So same information you've seen before. They go a little bit deeper into the obligating document. It tells you what a contract is, the agreement between the government and that commercial vendor. It goes into the MIPR, military interdepartmental purchase request. What you need to know for that is the difference, because on a MIPR, you have two types of MIPR. You got a project order and you have an Economy Act order. And so the best way to know the difference, a project sounds like something like once I start the project, I have to finish. So you cannot deobligate the funds at the end of the fiscal year for a project. Versus Economy Act, it's used for routine works or services. And typically you will deobligate remaining funds at the end of the fiscal year. So it's done with annual appropriation. Are there any other differences between the project order and Economy Act order? What types of organizations do we go into agreement with if we use a project order or Economy Act order? Any thoughts? Because projects can cross fiscal year. So typically, go ahead.
No, the
I like
Economy
the
Act,
input.
the money expires at the end of the fiscal year, correct?
Correct. So what type of agency am I working these Economy Act order with? Typically, it's another, I would say, like another government agency.
Yes.
Because I'm
So like
trying to,
Army, so like Army to
go ahead.
Army, or
Another, like I say, defense agency. Because I'm trying to see the difference. It's not in the book, but I always try to look at what's the difference between the two. Let's see, purchase request for requesting work or services from another government entity. That's a MIPR. The order, when accepted by the performing activity, should be obligated, and the MIPR may be issued as a project order, can cross fiscal year, and help users determine. Okay, so the older study guide, it told you the difference. So I have to look a little deeper on that one. But I know usually one is interdepartmental and intra-government. And I think the project is if you're working with another agency versus Economy Act. If it's another DOD agency, your MIPR is usually the Economy Act. And the project is usually tied, if you send them a MIPR and it's a project order, it's usually tied to a contract. That's also how you know, versus a reimbursable MIPR. Refresh your memory on the word outlays. Again, it is the same thing as a disbursement, but 9 times out of 10 in the CDFM, you'll see the word outlay. That's when the funds are removed from the Treasury to liquidate an obligation. That is the official definition. will see this other term in Module 2, that is the Future Years Defense Program. What that is, it's the DoD database. So everything that the DoD does and how we calculate and we come up with estimates is based on some type of systematic process, some type of system. And so the FYDP is a DoD database that what it does, it helps to keep track of all the defense programs, missions, and then the different appropriations that are used to fund those missions. So that's the DoD database. And I think this is the only one where I've seen the word database associated with it. And so it might be able to help you to remember. It also goes into the PresBud, the president's budget. And so the Future Year Defense Program, it captures the resources, the funding, the agencies, and the military departments, all their requirements is captured. So you have like a total. And that's kind of how they come up with the budget estimate submission, what they need to request. So Service and Defense Agency POMs and budget estimate submission, which are submitted to OSD in June through August, are then used to build those numbers, and eventually the totals are entered into the president's budget. And it also reminds us that by law, the president must submit the budget to Congress no later than the first Monday in February for the upcoming fiscal year in that October. In the Future Year Defense Program, it is divided into 12 major programs. That means when we say we're doing the authorization process is authorizing programs, well, know that there are 12 major programs. It's like a Rubik's Cube. There are 12 category of things that the Department of Defense, the different mission that the DoD does, and then they calculate the funding that's needed. So 12 is your number of programs. And I think in the older book, you have a diagram. So I'll just list the first 6: strategic force, general purpose force, command and control, whatever it is, one of those programs is what they have to list. And then the funding required. Guard and reserve is number 5. Let's see. They got different systems that we've already talked about in the first session. And also when you get to Module 2, you have Future Defense Program, and you also have the Comptroller Information System. The CIS is on the budget side. As they're coming up with the budget, the CIS is the system that is being updated. And the data is required by OMB's budget system. So the SecDef, that's the DoD system, the CIS, they're updating the budget numbers. The Future Year Defense Programs is being updated during the POM process. So don't forget that both of those processes are happening basically at the same time. All right, so lesson 2 of the accounting goes into federal accounting. And so this is the part now where it goes into the ledger, and it talks about the series from 1,000 and to 8, from 1 to 8, so that you know in accounting, a number that starts with a 1 is asset, starts with a 2 is liability, net position. And so you know your first formula because asset equal liability plus net position. Now, how you may see it again on an exam is you'll have a series of accounting numbers starting from 1 to 8. And so you have to know that, okay, if it starts with a 6, it's an expense. If it starts with an 8, it's a memorandum. If it starts with a 3, it's net position, because the formula would not be given unto you. So the different types of accounting, you have budgetary accounting. And so with that, It's resources equal the status of the resources. If you remember basic accounting, the left side must equal the right side. So however you add up your numbers, if you have to complete a ledger, just keep that in mind. So the budgetary accounting, budgetary are all your numbers that start with a 4. Are y'all catching on with me? Because if you looked at your study guide or even the older study guide with the different series of numbers on the ledger, that's what I'm talking about. So they have the same exact classification here. So your first formula, resources equals status of resources. And then you have proprietary accounting / financial accounting. So there's two formulas you're going to have to learn. And as I mentioned, the first one, your 1,000 numbers are your assets. Assets equal liability plus net position. So pretty much if you learn the charts, and if you have the new book, it's paragraph 2.1 of the accounting section on page 85, is learn that chart. And so it is easier to remember the formulas because the assets, liability, net position, 4,000 is budgetary. Then you have revenue and expenses. Because the next formula, let me see, is the net cost of operation, which is expenses minus your revenue. That's your 6,000 numbers, anything that starts with a 6, minus anything that starts with a 5. And again, it's not going to make sense until you actually pull up a ledger and see what those numbers are. But you're going to have to learn the formulas. So far we went over budgetary accounting and proprietary / financial accounting. Any questions thus far? And then net cost of operation, I think the older book, so I want to make sure I'm looking at the newer one because the other one was changing net position, but they don't have that in here. So it gives you the definition of net cost is the gross cost incurred by reporting entity minus your exchange revenue. So that's all it is telling you the formula. All right, so who can tell me what are two types of accounting?
Proprietary and budgetary.
Proprietary and budgetary. What's another word for proprietary? Proprietary. Okay. Financial accounting. So that's why when I say / because they have the two words together. So if it's proprietary, it's financial. They're talking about the same thing. And so like the older study guides, you have to look at the flow of fund to know what type of transaction is done at that time, from the time when Congress appropriates the funds until you actually outlay the funds. So we're not going to go through those again. Let's see, general ledger. They talk about the T accounts, and yes, you're probably going to have, maybe not too much since you're not using a calculator, but you're probably going to have to do a few of those formulas for the assets equal liability plus net position, or your status of resources, your resources equal the status of the resources, and so forth. So the document, when you are calculating a balance sheet, that's when you're using the formula assets equal liability plus net position, because you're actually calculating the balance sheet. So I know the older book, it starts off with, was it budgetary accounting, and then it goes into the balance sheet and then a statement of net cost or change position. So assets, liability, net position is your balance sheet. If they say, if you're given numbers from 1 to 5 and they say calculate the balance sheet, you only need your 1,000 equals your 2,003 plus 3,000 numbers. Statement of budgetary resources. We talked about that. So there's several asset accounts for the Department of Defense. That's the fund balance with the Treasury. And so these are more of definition. Undistributed disbursements. This means, okay, the federal government funds that has been paid but has not dispersed yet. So we've already did the transaction, but it hasn't paid out yet, or the money is still sitting in the Treasury. There are three categories of fixed asset, which are property, plant, and equipment. This is also in the older book. So straight information. So I'm not going to cover that. They go over again. So that's why I say a lot of it is repeat. That's why I always tell individuals, go through all three modules before you take your first test, because a lot of the information will overlap. So again, they go over the definition of a balance sheet, the statement of net cost, and the statement of change in net position, statement of budgetary resources. So I mentioned these earlier. So I'm highlighting as I go, so I don't have to repeat these. All right, what else we got? Managerial cost accounting. So we've talked about budgetary accounting, proprietary slash financial, and the third type of accounting is managerial cost accounting. So at the manager level, that's the third accounting system. And they have the definition there. So what do you think at the management level, what type of accounting is done there? What are they doing? So in CDFM, as a manager, you're doing a lot of ratio analysis. So you have two types. You have, current ratio, and the formula for that is cash plus accounts receivable plus your inventory. So that's every one of your assets that you have that value divided by what you owe. That is your current liability. Current ratio. I think the other one should be quick ratio if it's like this older book. So I just got these books, so I'm just going through this for the first time. And there it is. So the other formula is the quick ratio. So what you need to know, not just the formula, is why would you use, or what would be the scenario where you use your current ratio versus quick ratio. If you're doing the quick one, that means, okay, I don't have enough time to go over all my cash, my accounts receivable, that's how much people owe me, what monies are owed to me, divided by current liability. And then in the quick ratio is just my cash and accounts receivable divided by current liability. So the quick one is a test that I use for immediate solvency. If I have to go out of business today, what is the ratio of being able to break even? Let's put it that way. So I'm not losing too much. So a 1-to-1 is what we're looking for. So quick ratio measures your solvency rate, and current ratio measures your ability to pay your obligations. Any question? So ratio analysis under managerial cost accounting. That's one of the main focuses there. You're doing your government oversight like your supervisor, but again, you think of it on a business side. So let's see what else they have here. So it goes into more ledger, it goes over again with the formulas. Budgetary resources equals status of resources. So let's highlight that. So budgetary and proprietary. Proprietary, they repeat again, assets equal liability plus net position. What is the statement, the name of the statement where you use asset, liability, and net position? Let's see if y'all still awake. That is your balance sheet. I'm sorry, you're a little slow there. Got to be quick on the draw. All right. And so, of course, they have exercises. If you have the older book, I think I always recommend people to go to the exercises in the back for this particular one, just to get you familiar with the ledgers, the account lines, and what they mean. And you'll see what I'm talking about with the account numbers. If it starts with a 4, you know it's a budgetary transaction. Because if they ask you, is this an asset, a liability, or a net position? The answer is no. Because if it starts with a 4, it's a budget. And so you also will need to know the normal balance for each of those types of transactions from 1 through 8. And I think we are at the end of the accounting. Let me check. Yes. All right. So what are your questions on anything I discussed? And again, I try to look for things that are different than the older books, since most people have the older study guides. So if I said something that's not in the older one, but most of this information look like it's in the older books also, it is just formatted differently. Any question? All right, if no question, that's all I have for today. I do it in little chunks. Now it's your opportunity to go back and review the information. You're not going to recall it just from listening to me. Now, if you listen to my videos over and over, maybe like some people say they sit in the test and they hear my voice because they listen to it so much, but you have to consistently regurgitate the information. If you come to a topic and you know you've seen it before, talk about it to yourself. What did I learn? What do I know about this topic? Because it's all interrelated. There's nothing that's separated from the different modules. And you'll see some of the same information when you move on to module 2. So if there's nothing else of me as we are recording, if you have not already subscribed to our YouTube page, please go ahead and do so. Please, sir, please, ma'am. I would greatly appreciate it. And click the notification bell. It will let you know as I upload the new videos, you'll be able to see that. I probably won't complete the notes until a couple of days because I'm actually starting from scratch and with the newer books to make sure I'm capturing and adding in the new information. Then the notes link will be posted in the video appropriately. All right, so this is Helen Thomas and the CDFM Study Group. I'll see you guys again next time. Thank you all for stopping by.